Hi guys. Today we will analyze Caterpillar stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. Caterpillar was a medium performer in the overall market, due to the strong move around 9 months ago. However, there are some doubts in the recent evolution. The short-term trend is neutral, the long-term trend is neutral. It is advised to wait a little bit longer to see how this turns out. Support levels are around $208 and $200. The next support levels are around $190, $180 and $150. Resistance level is around $226. The next resistance level is around $236. In the last month the stock has been trading between $180 and $227 range, which is wide. It is currently trading near the high of this range. It may be a good idea to wait for a pullback before considering an entry. The stock has an average volume of 4.2 million. This is a good sign as it is always nice to have a liquid stock. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth, even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. Discounted free cash flow model, using the formula below, then, valuation based on earnings per share, 5-year average P/E ratio and expected growth rate. First model. Discounted free cash flow valuation. This spreadsheet contains some financial data that we will use for the stock valuation. We see that the average revenue growth rate of the stock has been around 7% per year, for last 5 years. We see that the average profit margin of the stock has been around 9% per year, for last 5 years. Also we see that the average free cash flow to net income rate of the stock has been around 86% per year, for last few years. And we expect 8% per year average stock market return. Now, let's consider 3 different scenarios for Caterpillar Company: bad, average, and good. First scenario. Caterpillar will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be low, 3%. Future profit margin would be low, 5%. Future free cash flow to net income rate would be low, 60%. In this case, the fair value of the stock today would be $79. Second scenario. Caterpillar will have average performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be average, 5%. Future profit margin would be average, 6.5%. Future free cash flow to net income rate would be average, 70%. In this case, the fair value of the stock today would be $121. Third scenario. Caterpillar will have high performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be high, 7%. Future profit margin would be high, 8%. Future free cash flow to net income rate would be high, 80%. In this case, the fair value of the stock today would be $177. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for the company is 11.77. Minimum rate of return. I will use 12%. Because when we invest in individual stocks, we are looking for a higher return than the S&P 500. For Caterpillar, analysts forecast growth rate around 7% per year in next 5 years, and future P/E around 18. Again, I will use 3 different scenarios for Caterpillar Company: bad, average, and good. First scenario. Caterpillar will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be low, 3%. Future P/E would be low, 12. In this case, the fair value of the stock today would be $66. Second scenario. Caterpillar will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 5%. Future PE would be average, 15. In this case, the fair value of the stock today would be $99. Third scenario. Caterpillar will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 7%. Future PE would be high, 18. In this case, the fair value of the stock today would be $140. As you can see, today the stock is overvalued, $222, even if we expect the company's high performance in future. Caterpillar has a medium profitability rating, but there are some concerns on its financial health. The stock has traded sideways between $180 and $222 since June 2021. Not much exciting going on here. And the stock is currently overpriced. I may consider buying the stock if the stock drops below $150. Company strengths. Caterpillar is the world's leading manufacturer of construction and mining equipment, diesel and natural gas engines, industrial gas turbines, and diesel-electric locomotives. Management has taken steps to reduce costs and bolster a balance sheet. Management's focus on margins should position the company for more consistent results. The recent 8% increase in the dividend signals confidence in the near-term outlook. Global industrial activity continues to recover from the pandemic downturn, with an added tailwind from the 2021 U.S. infrastructure funding law. Caterpillar should see strong demand growth amid a wave of delayed construction and natural resource projects getting back up and running. Caterpillar's return on assets of 8% and return on equity of 39% are amongst the best returns of the industry. Its profit margin of 13% is amongst the best in the industry. Caterpillar is a dividend king. The company has paid dividends since 1933. The current dividend yield is 2%. The revenue is expected to grow by 7 to 9% on average over the next 5 years. The earnings per share is expected to grow by 9 to 12% on average over the next 5 years. Risks. The company faces a range of operational and financial risks, and its performance could be hurt by rising interest rates, unfavorable exchange rate movements, and declining commodity prices. The pandemic posed a severe threat to the company's profitability. Due to the pandemic, Caterpillar is not currently providing detailed financial guidance for the full year. But margins are expected to narrow in first quarter 2022, due to higher material and transportation costs. Caterpillar generates more than 50% of its revenue overseas and its results are typically linked to global economic trends. Caterpillar's results are also sensitive to trends in the dollar. A stable or falling dollar would be a positive development for the industry and Caterpillar. Slow long-term growth in Caterpillar's key construction and fossil fuel production end markets, driven by lower demand for new office buildings, as more employees work from home, and potential for stagnant oil and gas drilling, as developed nation governments push their economies away from fossil fuels. Highly cyclical nature of the construction equipment, mining equipment, and engine businesses. Caterpillar's net debt-to-equity ratio, 177%, is considered high. The company also has an underfunded pension plan. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.